Hi there, this is Bill Starnes. In my last video, I talked about the basics of income taxation, but today I'd like to introduce the capital gains tax and go through 7 important concepts to understanding the capital gains tax. Concept number 1 is that the capital gains tax rates are progressive, just like ordinary income tax rates. So this simply means as your income rises, the higher chunks of income are taxed at higher rates. With capital gains, it's the same way. Now there are 3 capital gains tax brackets: 0, 15, and 20. And this 20% tax bracket was added in 2013, and therefore capital gains rates got more progressive in 2013. So I'm going to demonstrate how this works with an example where this client only has capital gain income to keep things simple. So with some capital gain, we can see that this capital gain that I just introduced through perhaps the client selling some stock was taxed at a 0% capital gain rate. But as they incur more capital gain income, we see that that gets taxed at a higher rate. Now this is being taxed at 15%. And with more income, it continues to fill up the 15% tax rate, and more income, and more income. So what we have here is a client with total taxable income of $600,000, but it's all capital gain. And we can see that the first $75,000 of capital gain was not taxed at all, 0% capital gain rate. The next chunk, $391,000, was taxed at the 15% rate, and any capital gain above that is taxed at the 20% rate. So you can see the rates are progressive, just like ordinary income rates, where as you have more gain, it gets taxed at a progressively higher and higher rate. The second important concept is that your capital gains tax rate is determined by what income tax bracket you are in. So the way to think about it is this. Here are the regular income tax brackets. And you see this dotted line here of $75,000 of taxable income? Well, if your income is under that line, you're either in the 10 or 15% bracket. And if you're in the 10 or 15% tax bracket, then you're also in the 0% capital gains tax bracket. And if you're in the 25 or 28 or 33 or 35% bracket, if you're in these brackets, your capital gains are taxed at 15%. And to the extent that you are in the 39.6% tax bracket, that's the highest one, then your capital gains are taxed at 20%. So these are the 3 capital gains brackets, and which one applies based upon what ordinary income tax bracket you are in. The third important concept is to understand that just because you're in the 10 or 15% tax bracket does not mean that 100% of your capital gains are taxed at 0%. In other words, if I have a client that drops into the 15% tax bracket in this year, this does not mean that they can sell stocks with $1 million of capital gain and those gains would be realized at a 0% rate. No. You only get the 0% tax rate until you cross into the next bracket. So think about it this way. If this is you with $60,000 of income, and you're clearly through the 10 and into the 15% bracket, and you have about $15,000 of income that you can realize before moving into the next bracket, that's the amount of capital gains you can take or harvest at a 0% tax rate. In other words, the reality is that the opportunity for the 0% capital gains tax is inherently limited. The 0% capital gains tax rate only applies until total taxable income rises up and out of the 15% bracket. So let's look at this another way. This is the same client with $60,000 of ordinary income and $10,000 of capital gain. And because they're still under this dotted line, they're still in the 15% bracket, they can harvest this capital gain at a 0% tax rate. But if this client were to harvest another $10,000 of capital gain, this is what would happen. We would see that they would get $5,000 of it still at the 0% capital gain rate. But after that, they have now crossed up and over and out of the 15% ordinary income tax bracket. And they are now into the 25% bracket. And therefore, that additional capital gain is taxed at 15%. And if they were to take more gain, it would be taxed, again, in the 15% tax bracket. Now watch what would happen to these gains if this client earned more income. So as they add more income, it pushes the capital gains up and out of the 0% rate into the 15%. You see, capital gains get stacked on top of ordinary income. So it is certainly possible if you're now in the 25% tax bracket and you try, or at the top of, let's say, the 15% bracket, as in this case, and you say to yourself, well, I'm in the 15% tax bracket, so I'll go ahead and harvest $28,000 of capital gain. Well, you're not going to pay a 0% tax on that capital gain. You're going to end up paying 15%. So that was actually our next concept, that you must understand the interaction between capital gain income and ordinary income in order to take advantage of the 0% tax rate. So here's a client with $50,000 of ordinary income, filling up fully the 10% bracket and a chunk of the 15%. But then they recognize $50,000 of capital gain income. The first $25,000 is taxed at 0% because they're still under this line. This line represents the top of the 15% ordinary income tax bracket. So that gain goes on top here. And then once they cross over this line, the additional capital gain is taxed at a 15% rate. The next concept is you never want to miss the opportunity to consider harvesting capital gains at a 0% capital gains tax rate. But, as we just saw, it's complicated. You must know how much ordinary income you will have for the year in order to determine how much capital gains to harvest. The problem is most individuals can't calculate their amount of ordinary income, because it really requires calculating your entire tax return during the tax year. And most professionals don't calculate it. You have to be able to calculate your current year tax liability, including ordinary income, above the line deductions, itemized deductions, phase outs, capital gains, qualified dividends, mutual fund capital gain payouts, and expected capital gains. But if you can do that, and that's what we do for our clients here, you will find that harvesting these capital gains at a 0% tax rate is fantastic. In this client's case, they have $50,000 of ordinary income, and we estimate that. And then we're able to see that they can harvest $25,000 of capital gains and still have all that gain taxed at a 0% tax rate. In other words, this client could sell an investment with a $25,000 capital gain and buy it right back again, thereby getting a free step up in cost basis. And you don't even have to die. This stepped up cost basis helps to reduce your future tax liability by chipping away at your capital gains now at a 0% tax rate. So I need to consider harvesting gains at a free 0% capital gains rate for those clients who have, an amount of income that keeps them in the 10 or 15% tax bracket. Now, I may prefer to recommend a Roth conversion instead at these low rates, but that's a topic for another day. The point is, you really have to consider taking advantage of this limited opportunity. Concept 6, your capital gains tax rate could be higher than advertised due to the 2013 Medicare surtax, also known as the net investment income tax, which is an additional tax on capital gains and other unearned income for higher income taxpayers. In other words, many taxpayers will think that their capital gains rate is 20% or 15%, when the truth is it's actually higher. So advertised tax rate for capital gains is, again, there are three. There's 0, 15, and 20. And this is represented by this blue area, where if a taxable income is very low here, and you're in the 10 or 15% bracket, then your capital gains rate is 0. But as your income increases, see, and this client's income is $147,000, then they are in the 15% capital gains rate. And as their income increases, the 3.8% Medicare surtax kicks in. So the truth, and let's keep going with this, at the 20% capital gains tax rate, the 3.8% surtax is still kicking in. So the truth is, while there are advertised rates of 0, 15, and 20 represented by this blue area, the truth is that there are actually 4 capital gains tax rates. 0% for lower brackets, 15% for middle brackets, 18.8% when you're in the higher brackets, and 23.8% in the highest brackets. See, the way the math works is if your income's high enough that you're in the 20% capital gains rate, by definition, you are subjected to the Medicare surtax, and therefore, you're actually in the 23.8% tax rate. So, the truth is, there are 4 capital gains rates. I mean, that's the way the math works. 0, 15, 18.8, and 23.8%. So that brings us to our last concept. Due to these new tax brackets and the higher brackets and the higher rates due to the Medicare surtax, deferral is no longer the best strategy. In the past, it just didn't matter. I mean, higher income folks were pretty much, their capital gains were 15%, regardless of how much they harvested. But now, because of these additional brackets in the Medicare surtax, you can't just defer. You want to consider harvesting, as I demonstrated earlier. You know, if you defer, your gains will build so high that you'll have no other choice but to be exposed to the 23.8% capital gains rate, especially if you're over age 70, taking your minimum distributions in Social Security. So naturally, if a client's income is down here, sure, they may want to harvest some gains at 0%. But if a client's income is out here, then certainly deferral is the best strategy. If a client's income is here, you also may consider deferring to avoid jumping into this higher capital gains rate of 18.8%. So in other words, you have to be very conscious and purposeful with harvesting or deferring capital gains now. It's just no longer simple. So there we have it, 7 critical concepts for understanding capital gains. Thanks for listening, and we'll talk to you next time. Bye.